U.S. Commerce Secretary Lutnick has conveyed optimism about the ongoing trade negotiations between the United States and China, which are reported to be progressing positively. The discussions, held over the past 2 days at Lancaster House in London, involve representatives from both countries and aim to resolve significant trade issues between the world's two largest economies. Lutnick highlighted the commitment and collaborative spirit demonstrated by both parties, expressing hope for a resolution by Tuesday evening, though he noted that talks might extend into Wednesday if needed to reach a comprehensive agreement. The progress in these negotiations is considered crucial due to the long-standing trade tensions that have impacted global markets and economic stability. A successful outcome could ease these tensions, potentially leading to the reduction or removal of tariffs that have affected sectors such as technology and agriculture. This could stabilize or boost market sentiment, influence stock prices, and foster a more favorable environment for international trade. The resolution of these discussions could have far-reaching implications for global trade policies, economic growth, and bilateral relations, affecting supply chains and economic strategies, not only in the U.S. and China but also globally. Investors and market participants are closely monitoring the talks, as their outcome could significantly impact economic forecasts and market dynamics.
The Trump administration's decision to potentially terminate the Job Corps program has put nearly 200 jobs at risk in San Diego. The U.S. Department of Labor announced plans to halt the program, citing a $140 million deficit, limited graduation rates, and frequent violent incidents as key reasons for the decision. However, a federal judge has temporarily blocked the shutdown until June 17, following claims that the administration overstepped its authority, as the program was established by Congress. The Job Corps, which began in 1964, is the largest job training initiative for low-income youth in the U.S., offering vocational training in fields such as welding, nursing, and carpentry. The potential closure of the San Diego Job Corps Center, operated by Management and Training Corp., underscores broader debates about the effectiveness and funding of federal workforce programs. While the administration argues for fiscal responsibility and measurable outcomes, supporters emphasize the program's role in creating skilled workers and providing opportunities for disadvantaged youth. The outcome of the legal proceedings could impact not only those employed at the San Diego Center, but also the approximately 50,000 students served annually across 120 facilities nationwide. The decision will likely influence future federal workforce investment strategies and the availability of vocational training for underprivileged communities.
Meta Platforms Inc. Meta is poised for a potentially lucrative period, as historical data suggests that the company enters its most statistically favorable 30-day stretch of the year, from June 11th to July 11th. Over the past 13 years, Meta shares have shown a consistent pattern of gains during this period, achieving positive returns in 12 of those years, with an average return of 6.3%. This trend is underscored by minimal drawdowns, indicating a steady upward movement. Currently, Meta's stock is trading at $698, approximately 6% below its all-time high of $740, setting the stage for a potential breakout to new record levels if historical patterns hold true. Meta's strong year-to-date performance, with a 19% increase, surpasses the broader Nasdaq 100 index's 4% rise. This growth is buoyed by robust earnings, including a 16% year-over-year revenue increase to $42.3 billion, and a 35% rise in earnings per share to $6.43, as reported in April. The company's aggressive monetization of AI products has also contributed to its strong market position. If Meta follows its historical trend during this favorable period, the stock could rise by $44, potentially reaching $742 by mid-July, further solidifying its bullish outlook.
Meta Platforms has made a significant move in the artificial intelligence AI sector by acquiring a 49% stake in Scale AI for $14.8 billion, valuing the startup at over $30 billion. This investment underscores Meta's aggressive strategy to enhance its AI capabilities, which have already contributed to improved ad targeting and user engagement on its platforms like Instagram and Facebook. The collaboration aims to bolster Meta's AI development, potentially leading to new consumer products and services, such as advanced AI models and subscription offerings. This strategic alignment with Scale AI reflects Meta's commitment to maintaining a competitive edge in the rapidly evolving AI landscape. In parallel, Wells Fargo is poised for growth in its investment banking division, following the removal of a $1.95 trillion asset cap imposed by regulators. The bank's CFO, Mike Santomassimo, highlighted the newfound flexibility in capital allocation, which is expected to drive fee-based revenue through advisory and underwriting services. This development coincides with a broader resurgence in Wall Street deal-making, as evidenced by recent IPOs like Gemini and Circle. The lifting of the asset cap allows Wells Fargo to capitalize on the improving market conditions, potentially leading to increased profitability and market share in the investment banking sector.
Casey's General Stores has seen a significant rise in its stock, reaching a new 52-week high, following a robust earnings report that exceeded expectations. CEO Darren Rebellas attributes this success to a heightened consumer focus on value, a trend he links to the aftermath of the COVID-19 pandemic, which brought about supply chain disruptions and inflationary pressures. As interest rates have risen, even affluent consumers are becoming more discerning about their purchases, seeking greater value for their money. This shift in consumer behavior has benefited Casey's, particularly in its offerings of fuel, groceries, and a popular range of made-from-scratch pizzas. The company's strategic expansion is also noteworthy, with plans to open numerous new locations, especially in Texas, where there is significant growth potential. Currently, Casey's operates 170 stores in Texas, a state with a population of 30 million, compared to its home state of Iowa, where it has 550 locations serving a population of 3 million. This expansion strategy is poised to leverage the growing demand for value-oriented retail, potentially increasing Casey's market share and enhancing its competitive positioning in the convenience store sector.
Bank of America has announced plans to permanently close 19 of its branch locations by the end of 2025, affecting states such as California, Florida, and Texas. This move is part of a broader trend among major U.S. banks to reduce their physical footprint in response to the increasing shift towards digital banking services. The closures reflect a significant industry-wide shift, as data from fintech company Self Financial shows an average of 1,646 branch closures annually since 2018. The trend suggests a potential future where physical bank branches could become obsolete by 2041 if the current pace continues. This strategic decision by Bank of America aligns with similar actions from other financial institutions like Flagstar Financial, which is set to close at least 60 branches by year-end as part of its restructuring efforts to cut costs after a reported net loss of $845 million in 2024. The closures are driven by a need to reduce operational expenses, such as rent and maintenance, as banks increasingly leverage technology to offer services like check deposits and fund transfers via mobile apps. The shift is also a response to consumer demand, with over 69.9% of Americans indicating a need for change in the banking system. This ongoing transformation in the banking sector underscores the growing importance of digital solutions and the need for banks to adapt to evolving consumer preferences and technological advancements.
Penn Entertainment has recently been the subject of analysis by 7 financial experts, revealing a variety of perspectives on the company's future performance. The average 12-month price target for Penn has been adjusted to $21.93, a decrease of 7.23% from the previous target of $23.64, with estimates ranging from a high of $26 to a low of $16.50. This adjustment reflects a shift in analyst sentiment over the past 30 days, suggesting a more cautious outlook on the company's market potential. Penn, which operates 43 properties across 20 states under brands like Hollywood Casino and Ameristar, derives 85% of its sales from land-based casinos, with the remainder from its interactive segment, including sports, iGaming, and media revenue. Financially, Penn Entertainment demonstrates strong profitability with a net margin of 6.68% and a prudent debt-to-equity ratio of 3.7, indicating effective cost management and a balanced approach to leveraging debt. However, its revenue growth of 4.08% as of March 2025 lags behind industry peers in the consumer discretionary sector. Additionally, the company's return on equity (ROE) and return on assets (ROA) stand at 3.83% and 0.74% respectively, with the latter indicating challenges in asset utilization. The company's strategic partnerships, such as with ESPN, aim to enhance its digital presence and capitalize on the growing sports betting and iGaming markets, potentially offsetting some of the challenges in asset returns. Overall, while Penn Entertainment's financial strength is evident, its market position and growth prospects remain under close scrutiny by analysts.
Lucid Group, LCID, has experienced a notable increase in short interest, with the percentage of its float sold short rising by 4.34% since its last report. Currently, 369.87 million shares, or 45.4% of Lucid's available shares for trading, are sold short. This level of short interest is significantly higher than the peer group average of 5.69%, indicating that investors are particularly bearish on Lucid compared to similar companies. The high short interest suggests that traders are betting on a decline in Lucid's stock price, as short selling involves selling borrowed shares with the hope of buying them back at a lower price. The elevated short interest in Lucid Group could have several implications. While it may signal bearish sentiment, it's essential to recognize that high short interest can sometimes lead to a short squeeze. A short squeeze occurs when a heavily shorted stock's price rises sharply, forcing short sellers to buy back shares to cover their positions, which can further drive up the stock price. Investors should monitor Lucid's stock movements closely, as the high short interest could lead to increased volatility. Additionally, the company's performance and strategic decisions will be under scrutiny as market participants assess whether the bearish sentiment is justified.
Jaiprakash Associates Limited, JAL, the holding company of the JP Group, faces uncertainty in its corporate debt resolution process due to the unclear strategy of lenders regarding Jaiprakash Power Ventures Limited, JPVL. JPVL, with a market capitalization exceeding 12,000 crore rupees, is a significant asset for JAL. In 2019, JPVL issued compulsory convertible preference shares, CCPS, worth 3,800 crore rupees to its lenders as part of a debt restructuring effort. These CCPS can be converted into equity shares, potentially making the lenders substantial shareholders in JPVL. However, the timeline for this conversion remains open-ended, creating uncertainty for potential bidders of JAL, including major corporations like Adani Enterprises and Vedanta. This uncertainty affects their ability to accurately value JAL's holdings, as the conversion could dilute JAL's stake in JPVL, which currently stands at 24%. The National Asset Reconstruction Company Limited (NARCL), which holds the assigned debts of JAL, has yet to clarify its stance on the CCPS conversion. The ambiguity surrounding the conversion timeline has led to an extension of the deadline for submitting resolution plans to June 24, from the previous June 9. JPVL remains a profitable entity with a 2.2 gigawatt electricity generation capacity, adding to its attractiveness. However, the unresolved issue of CCPS conversion poses a significant hurdle in the debt resolution process, impacting the strategic decisions of potential bidders and the future control dynamics over JPVL. As JAL navigates through the corporate insolvency resolution process, the outcome of the CCPS conversion will be pivotal in shaping the company's restructuring and ownership landscape.
Vale, the leading global producer of iron ore and pellets, has seen notable activity in its options trading, indicating a bullish sentiment among major investors. Recent data reveals that 62% of the options trades were bullish, with significant market activity focusing on a price range between $8 and $10. This trend is crucial for assessing liquidity and investor interest in Vale's options at specific strike prices. The company's strategic focus on core mining operations, particularly iron ore, nickel, and copper, aligns with its recent divestment of non-core assets, including a 10% stake in its base metals business, underscoring a potential restructuring or spin-off strategy. Market analysts have provided mixed sentiments on Vale's future performance, with a recent price target set at $11.30. Despite a downgrade from CICC to an outperform rating, the overall outlook remains cautiously optimistic. The bullish options activity suggests confidence in Vale's ability to navigate market challenges and capitalize on its core strengths. As the company continues to refine its asset portfolio, investors and traders are advised to monitor further developments and strategic announcements closely.